If 2025 felt expensive and stressful, 2026 is the year where your money decisions either start fixing that or quietly make it worse. You are dealing with higher prices than a few years ago, debt that is more expensive to carry, and an economy where one bad move with credit, cars, or housing can lock you into years of payments. This video is not about fancy investing tricks. It is about avoiding the specific, easy to make mistakes that leave people feeling stuck, broke, and behind even when they are working hard. So your money in 2026 actually moves you forward instead of just helping you survive. Pretending high interest rates don't matter. One of the fastest ways to lose financially is to act like the price of your debt hasn't changed. A lot of people are carrying credit cards at 20% or more, personal loans in the teens, and car loans with painful rates, but because the minimum payment fits in the budget, they treat it like no big deal. The problem is that every month you leave those balances alone, you are sending future use money straight to the bank in interest instead of using it to build anything for yourself. This is why aggressively attacking high interest debt needs to sit near the top of your priority list this year. It often beats almost any investment you could make because paying off a 22% card is like getting a 22% guaranteed return on your money. Start by listing every balance, sorting them by interest rate, and circling anything in the double digits. Then, decide which one you are going to hit first with every extra dollar you can find, side income, refunds, bonuses, while keeping up minimums on the rest. In a year where money already feels tight, ignoring expensive debt is not neutral. It is one of the biggest mistakes that keeps people stuck even when they are earning more than ever. Treating inflation like it's over. A lot of people made one quiet mistake after the big inflation headlines disappeared. They assumed the danger was gone and went right back to parking cash wherever was easiest. Even if prices are not spiking like they were a few years ago, the cost of almost everything is still higher than it used to be, and your money sitting in a near zero account is slowly losing buying power month after month, leaving a big chunk of savings in a basic checking account that pays almost nothing might feel safe, but it is more like watching your future shrink in slow motion. The move this year is to separate safety from laziness. You still need an emergency fund in cash, but that cash should be working as hard as it safely can, usually in a high yield savings account and not just sitting in the default account your bank gave you. It takes maybe an afternoon to open a better account and redirect your savings, and that one decision can quietly earn you hundreds of dollars more over the year with zero extra effort. The mistake is not feeling inflation day to day and assuming it is gone. The smart play is acting like it is always there in the background and choosing where you park your money accordingly. Buying the payment, not the car or house. One of the most expensive mistakes is thinking, if the monthly payment fits, I can afford it. With cars, that looks like signing up for a 7-year loan just to get the payment under some number in your head, without realizing you are paying a huge amount of interest on a rapidly depreciating asset. With housing, it shows up as stretching to the top of what a lender will approve, ignoring how property taxes, insurance, maintenance, and higher utilities stack on top of the mortgage. On paper, the payment might technically work. In real life, it leaves you one surprise away from panic every month. The smarter move is to flip the way you think about big purchases. Instead of asking, can I squeeze this monthly number into my budget? Ask, what percent of my take-home pay am I comfortable locking up in this, including all the hidden costs? Then run the full math. How much total interest you will pay over the life of the loan, how long you will be stuck with it, and what that does to your ability to save, invest, or handle an emergency. In a year where debt is already more expensive, buying the payment instead of the actual asset is how people look successful on the outside and stay financially trapped on the inside. Waiting for the perfect time to invest. A lot of people are planning to start investing when things calm down or when the market crashes, and that mindset is one of the biggest money mistakes you can make. There is always some headline, elections, recessions, interest rate moves, global drama that makes it feel like now is a bad time. So months turn into years of sitting in cash while prices and your own life keep moving. The result is that you miss entire chunks of compounding, not because you chose bad investments, but because you never actually got in. The better approach is to accept that there will never be a perfectly calm moment and build a simple, automatic system instead. That might look like picking a low cost index fund, setting up a monthly transfer on payday, and focusing on consistency rather than trying to guess tops and bottoms. You keep true short term money in cash or safe accounts and let long term money ride out the noise. In 2026, with everything feeling uncertain, the mistake is waiting for a feeling of safety that never arrives. The smart move is starting small, starting now, and letting time, not your emotions, do most of the work. Ignoring future you in a survival year. When money feels tight, it is easy to slip into survival mode and tell yourself you will think about the future later. You cut retirement contributions just for now, skip putting anything into savings, delay learning new skills, and promise that once things calm down, you will catch up. The problem is that years like 2026 don't pause the clock. Rent still goes up, your body still ages, and opportunities still pass by whether you are ready or not. What feels like a temporary break from planning can quietly turn into a multi-year gap where nothing is compounding for you. No investments, no safety net, no growth. Avoiding this mistake does not mean pretending things are easy. It means refusing to let a tough year steal everything from your future self. Even tiny moves matter. Putting 1 to 5% of your income into a retirement account, auto-transferring a small amount into an emergency fund each payday, or investing a little in skills that could raise your income next year. The dollar amounts might feel insignificant in the moment, but the real win is staying in the habit of paying future you first. In a year where everyone feels squeezed, the people who still protect their long-term self, even with small numbers, are the ones who will look back and be glad they did not wait for the perfect time to start acting like their future mattered. If this breakdown made you realize you've been sleepwalking through your money, that's not something to be ashamed of. It's a starting line. Most people will watch a video like this, nod along, and then do exactly what they did last month. If you want a different life a year from now, pick one mistake from this list to fix this week. Not all of them, just one. And if you want help staying on track while everything this year tries to pull your attention somewhere else, subscribe and stick around. This channel is going to walk through the exact moves that ordinary people are using to quietly get ahead while everyone else is stuck on repeat.